so to help us examine this volatile economic picture. We're with BNP Paribas Global Head of Market Economics, Paul Mortimer-Lee. Thank you very much indeed for speaking to us.
Pleasure.
So, I mean, do we have a situation right now where exchange rates don't seem to reflect the economic fundamentals?
Well, to some extent. I mean, clearly, let's talk about the dollar first. The US economy is weak, it's stumbling, and the Fed is going to quantitatively ease. So the dollar should be weak. It's appropriate it's weak. You know, they still have a big current account surplus when the economy is well below full employment. So the dollar should be weak. It's a question of who, against which currencies should it be weak. And clearly, I think emerging market currencies are the real favourite to appreciate against the dollar. And the reason is that many of those economies have closed their output gaps, they're at full capacity, interest rates are above US levels and they need to be allowed to rise, but that's being stopped from happening. So it's really those currencies, I think, that are a problem. Of course, if those currencies won't rise, then the pressure has to go somewhere else. And that has been on the euro and the yen. And I think that's really what's causing discomfort in Europe and discomfort in Japan, that the pressure that's coming from appropriately soft US monetary policy is really all coming onto them. And that's really not sustainable.
So we keep hearing that lower exchange rates will help lift the economy by boosting exports. But what are the risks associated with this type of unilateral action intervention in the currency markets?
Well, I mean, when you're talking about unilateral intervention, who are you meaning? You meaning the US? Because I don't think the US is setting out to weaken the dollar. I think the dollar weakness is a side effect of domestic monetary policy.
OK, well, let me then ask you, what could more stimulus in the US and the UK mean for their currencies?
Well, if we get more monetary stimulus, if we get more liquidity pumped into the market, of course, their currencies will tend to depreciate. And and that's entirely desirable and natural. If other countries don't like that, if the Eurozone doesn't like that, then it has to set its own monetary policy appropriately. But, you know, what we've got at the moment is the ECB's talking about, well, we're going to continue towards the exit when other countries are clearly going towards the entry. Now, if they want to do that, then that's up to them. And I don't think they can complain that the US is really trying to depreciate the currency. It's not. It's trying to avoid deflation. You know, core inflation is only 0.9%. If it stays at these levels, inflation expectations will break down. Should they become Japan, or should they try and do something about it? And they're trying to do something about it, and the ECB doesn't like it. Well, it needs to set monetary policy differently.
So will more stimulus work, in your opinion? Will it help avoid a deflationary situation?
Will the US QE? Yeah, of course it will. Ultimately, central banks can control inflation. There's not much else they can control in the longer run, but they can control inflation. And we've seen already that, you know, US action has had an influence on asset prices, and it will have an influence on other countries' monetary policy. We've seen that Australia didn't hike when almost everybody except BNP Paribas expected them to hike. We've seen Brazil impose capital controls. People globally are worried about a weaker dollar because of the impact on their economies. But it's a question of global imbalances. Is the global economy balanced? No, there are still too many imbalances. And what we really need is much more domestic demand stimulus in emerging markets.
Thank you very much indeed, Paul Mortimer-Lee,
Pleasure.
Global Head of Market Economics at BNP Paribas. Appreciate getting your thoughts.